Well, hello. Today we're going to talk about rental properties. Now, I often get a lot of questions about how do you tell if your rental property is a cash cow or if it is a black hole that you just keep shoving money into that's really never going to do anything for you. So we're going to spend a little bit of time, not too long, and I'm going to try and walk you through some steps. Now, in a lot of cases, you're going to need some help on this, but I'd like to open your eyes because most of the time, an individual looks at a property and they really don't know what they're seeing on their tax return, or perhaps you're considering buying a property, and maybe this will help you along some of that journey. We're going to do a little bit of screen sharing here so I can walk you through some slides and some things that I think that will end up helping you. So let's go ahead and get this going from the beginning. All right, so today we're going to talk about rental properties. Are those a black hole or a cash cow? And so at the end of this presentation, you'll probably know more than most landlords and things on that side of it. Now, I always give a lovely little disclosure. These are general concepts only. You have a unique situation, and I would anticipate you should speak to your advisors. If you don't have one, my contact information will be over in the chat, and you're certainly welcome to reach out to me. Now, I'm not giving you any kind of individual advice, and all of these wonderful notes are to keep the attorneys happy. Again, reach out to your own professionals, but these are general concepts. Now, I think I already own or I could purchase the ideal rental property, but how do you know if it has the potential to be a cash cow for you? Because there's no point in owning a property that is not generating revenue for you. And at least that's the opinion that I hold based on what I have seen over the years. If you just want to throw your money away, you can do that. And you don't have to have the headaches and the hassles of owning a rental property. The other thing I would mention is periodically I'll try and check notes, and we'll circle back at the tail end, and I'll be answering some specific questions as they come up. Now, on a cash cow, for my definition, I want a property that is not only making expenses, which that's barely breaking even, and breaking even is never enough, but you will need to decide for yourself what is a reasonable return on your investment, because that amount has to be earned over and above whatever the property is earning that breaks even. So in an example, and you'll find it when you watch my classes that I really like round numbers, they're so much easier to work with, that if we have a $100,000 property and I want a $7,000 gross return, then that means over and above expenses, I want at least $7,000 of profit. And that's a gross return because I have not paid taxes yet. And depending upon the tax bracket you're in, that can change what your expectations are. Now, if you would notice that if I have a 10% tax rate, then I have got to earn an additional $780, gross it up, in order to net the 7% that I'm looking at. If I wanted to bump it to a 12% rate, you'll see on the slide that now I've got to bring that up to about $8,000. 22%, now I'm at 9. So again, depending upon what your tax bracket is and what your earning expectations are, it can dramatically change how much a property has to earn in order to meet your expectations. Now, if you have unrealistic expectations, no property will meet that criteria, but there are properties that will. Now, on a cash cow, when we get down to some of my definitions, it's name the realistic rate of return you want to generate, and you need to factor in some rates, because for some of you, a cash cow may be a property that is generating, 3% because you feel like you're doing better than you would do in a CD or some very, very low risk investment. Others are going to compare that to what they might be doing in the stock market or a 401k, and they may be looking for an average of double digits. But a cash cow definitely has to be meeting all of its expenses, and it has to be doing a rate of return that is reasonable for you based on what your risk criteria could be. Now, in my situation, I do not count on appreciation as helping to carry me on this property. I've looked at a lot of real estate contracts and I've seen a lot of closing documents, but I have never seen one that guarantees you what an appreciation rate will be on any property that you may purchase. And when I look at that and someone says, well, I don't care if it's not making money now, I'm going to get my money later. Well, we're going to talk about that because I don't believe that's always true. If you look at my hypothetical examples in front of you, I picked some pretty modest rates of appreciation, anywhere from 1.5 to 4.5%. And you can see how it changes the value of the property over that time frame. And if I go down to, let's take the bottom one. We have a hypothetical $100,000 property. You could use any number you wanted. And if I have a hypothetical 4.5% inflation rate, then you'll see that within 30 years, it looks pretty good on paper that my $100,000 property could be worth $374,000. So far, this looks pretty good. But now let's take that a step further. Well, what happens if I have an identical inflation rate? Well, it's the exact same number. So whereas the $100,000 may have grown to 374, you have the same buying power on the $100,000. And the other thing that has happened to you at this point is we're going to have taxes that we have to pay on any gains. So if the property appreciated about the same amount that inflation did and you have to pay taxes, I don't see where you've gotten this great big gain that most people assume is there. Will this be unique to each property? The answer is yes, because some areas will appreciate much more, and it depends on when you choose to sell the property. And some properties will actually decline in value, or maybe the area goes downhill. You don't get out soon enough. All of those things are the risks that go along with having a property. Wherever there are risks, there are rewards. But again, when there's rewards, there's risk. You have to balance those type of things. Now, when we're looking at some of the other things, what I can do on a very simple profitability test, and this one is fast. It doesn't matter if you already own the property or if it is a property you are considering adding to your rental portfolio. I use the 1% rule. The 1% rule takes whatever the value of the property times 1%. And if I cannot get at least that number for rent, this is not going to be a cash cow. It is going to be a gaping black hole that you will throw your money in incessantly. Very easy. If I have a $200,000 home times 1%, then at a minimum, I have to get $2,000 a month that's going to be carrying my expenses, maybe a little bit of a vacancy, but I have not made a profit. All I've done is barely been able to carry that property at that point. Because remember, whenever you have a property, you are going to have insurance. You may have a mortgage payment. You may have taxes. What about management expenses, repairs? Now we're looking at, on a typical property, depending upon the age and the condition of it, I usually allocate somewhere between 1% and 5% a year just to maintain the property. I did not say upgrade it. That's to maintain it. Now on this $200,000 property, that could be $2,000 to $10,000 a year. If I'm only getting $2,000 a month in rent, then I could theoretically think, oh, I'm going to lose 1 to 5 months of rent just to maintain the property. You may be doing bug spray. You may have to do yard care, trim trees. All of those things are expenses of the property that have to be taken care of before you ever make a dime of profit. What happens if your property has a pool? Do you have homeowners association dues? Are you paying part of the utilities? Maybe it is a unit that has an upper and a lower, but you don't have the utilities split out. What other things do you have with that property? Now, if you grab your calculator on a cell phone and you start doing some of these numbers, if you already own a property, we're going to look at a couple of tax examples. But again, this is a method you can do very quickly in your mind. Whatever the value of the property is times 1%, can tell you very quickly whether you have the potential for the cash cow, or if perhaps you've got one of those gaping black holes that's doing nothing but sucking money out of your wallet at this point. Now, when I am dealing with individuals, when they are choosing between renting and buying a home, we're still going to look at the 1% rule, but you're not a renter, you are a landlord. And so when you have individuals that are looking, depending upon whether they're trying to decide what is going to be better for them, renting or buying a property, you have got to be over that 1% number. You don't have any leeway at this point, in my opinion. So when we're looking at this $200,000 house example, again, you can choose any number you want. If we have all the liability for repairs and maintenance, we already mentioned somewhere between 1% and 5%. Now I've got a load that I've got to carry of $2,000 to $10,000, whether I have anybody in the house paying rent or not. Well, that's about $167 to $833 a month. Depends on the house, depends on the climate. What else might we have to come up with? Well, what if you were planning on selling this property in 5 years because you thought that the properties would significantly appreciate, or maybe you got it in not so great condition and you brought it up to where it is a much better asset as far as being attractive for sale. Now, if I looked at that and I said, hypothetically, it's $200,000, I will estimate sales cost at 10%. It may be a little more, it may be a little less. It depends on your area. But when we start looking at any type of real estate commissions, if you have attorney's fees, if you've got to pay any type of title transfer insurance, I just use 10% as a nice, easy round number. If I'm planning on selling this property in 5 years, then I believe that we've got to take into account those estimated selling costs. Now, if I take my $20,000 divided by 60 months, which is the same as 5 years, then I need to factor into my equation an additional $333 a month for those selling costs that's going to come out of my pocket a little bit later. Selling costs don't do anything for my bottom line profitability. And that's assuming that we don't sell it at a loss from what you paid for it, because you don't really know what's going to happen 5 years from now or what could happen in a neighborhood. Now we're going to look at the same $200,000 house example. Well, what about homeowners insurance? Most people are going to have homeowners insurance because maybe you cannot afford to have a $200,000 asset that is not insured. In the event that it burned down, damaged, whatever the case may be, that may be more of a loss than you can absorb. So you'll have homeowners insurance. Well, how much is that? Really depends. Now, the homeowners insurance depends on the area you live in. And of course, we have had a lot of increases the last few years. We've had a significant amount of damage from hurricanes, wildfires, ice storms, those type of things, tornadic activity, all factor into what the rates are when it comes to insuring your policy. Now, depending upon your area and what is normal, maybe you even have to add flood insurance if that's a risk that you have. That's a cost of carrying that property that doesn't build your bottom line. And it's not a place to cut coverage if you cannot afford it. For example, do not take a 10% or $20,000 deductible if you know that you can't come up with the first $20,000 if nothing was paid for by insurance. It may not work for you for each claim. Now, if I said that it was 2% of value, again, I'm just guessing here, that would be an additional $4,000 annually that property needs to be able to carry. That's another $334 a month. Now, on this same $200,000 house example, now we've already talked about, we've got repair funding that's somewhere between $167 and $833 a month. The selling costs, they're $333, the homeowners $334, the taxes, I'm saying $150 a month, that's a guess. And then I call it the costs, privileges, and responsibilities of being the owner, as we've already front loaded this property between $984 and $1,650 a month. And we haven't made a payment and we haven't made a profit yet either. So when I'm looking at, remember that 1% rule, when I say you have got to be making at least 1% to have any hope of being able to make a profit on the property because of these various expenses that we add in at this point. So what if you're charging less than 1% of the market value? Well, can you raise the rent? And you may have to do that gradually in order to maintain occupancy. If this property is not going to be able to give you at least 1% of the value, it may not ever be a cash cow. That's something you'll have to evaluate property by property, not by the portfolio as the whole. What can happen is that you can have a property that is draining a lot of your profits, but because you own multiple properties, they're all tossed in the same mix and you're not able to pick them out because all you're looking at is the number overall. And we want to look at each property individually. You know, are there any costs that you could reduce realistically? Sometimes the answer is yes, sometimes the answer is no. And then we also have to factor into this, what types of repairs or appliance replacements are coming up within the next 1 to 5 years. What could be a profitable property now if you're looking at it within the next 5 years and it's going to need a roof replacement? You are concerned that you're going to have to replace several appliances. Maybe we've got an AC repair. Maybe you're concerned about plumbing or electrical issues. Maybe the windows need replaced. If we look at it and look at the cost and say, you know what, within the next 5 years, this is going to change to where this is no longer a cash cow. This is going to become a profit sucking liability to me. Then you may want to relinquish or let go of that property before you're on the hook to do all of those repairs. So look ahead a little bit. So when I say, is it time to sell the property and move on? This is something that you need to monitor on an ongoing basis. Well, we're going to talk about some sample rental properties because I think looking at real things is the most helpful. And when we go through those, sometimes, you know, I can look at it and I can quickly pick up some numbers and bing, 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 and say, oh, we have a problem here. We don't have a problem here. But many of you get your tax returns and it's almost like reading a book, but it's a very boring book and all the numbers make your head spin and you don't look at the individual pieces. When you sign the papers, you're either smiling because it's a number you like, or you frown because it's a number that you don't like. But for many of you, we need to go back or look at the properties that are over the last 3 to 5 years of ownership to see a realistic period of time of how these properties have actually performed for you, standing alone, not mixed into the mix. And whether you own one property or 101 properties, they still have to be done individually. These are called Schedule E. You know, Schedule E is for Schedule E as in Edward. And this is going to be in your tax return. And when you go through, there's a lot of information that comes up. On these examples, you're going to see there's the rent received. Did we have any travel? Did we have any legal fees? You're going to notice on this particular property, we don't see any mortgage interest. So they either paid cash for it or they've owned it long enough there is no mortgage. There isn't one on here either. But even if there was a mortgage, you do not get to deduct the principal portion. You only get to deduct the interest. And in the early years, your interest is a significant amount and very, very little goes towards principal. We've got repairs, property taxes, depreciation. What's that? Well, they call depreciation a paper loss. That is a number that you get to take off of your taxes now, but it comes back later. And so it never really goes away. It's kind of like put away and off to the side for just a little bit. Will it vary by property? Yes. Depends on how long you own the property. You're going to see on these entries, if we look at line 18, that we have depreciation on this particular set. But if we look on this other example that I've inserted here, these have no depreciation. That tells me they've owned these properties for probably 30 years, and that depreciation has all been taken at this point, and only this one property still has some depreciation on it. The other thing that the depreciation allows us to do is to have at least an idea, if you have no clue, what we might need to do as far as setting up a budget for maintenance and repairs. We have all of the expenses. So if we take the rent minus the expenses, it gives us an idea of what the profitability of that property was on a given tax year. And in this case, we have 3 different properties here, and you're going to notice that the profitability varies widely between them. I have 3 other lower end properties here. And if we're looking at some of this and going through, well, you're going to see that the profitability that comes down on this particular one, we've got 2 that are profitable. Wow, this one lost a significant amount depending upon who you were. That's real live green cash money at times that you don't have. But then you notice these little brackets down in 22. Well, depending upon what your income is and what are some of the other entries on your taxes, you may or may not be able to deduct all of the losses, or you may have carryover losses. So there's some other things that are going on behind the scenes, but these really tell the tale on each property that you own on what it looks like. So when we're looking at those sample rental properties, can you tell off the bat without help whether you're making a profit or not when you look at depreciation? Well, for most of the individuals I work with on rental properties, the answer is I don't have the faintest idea. This is more than I've ever known at this point. All right, you may need a little help there. So if we go back, how can you quickly tell if any of these sample rental properties have losses or profits for tax purposes? What line do we go to? Well, if we go down here, we can see that we have got profits on this line. Now, are there deductible losses? In this case, the answer is no. So we're going to be looking down towards the bottom of the form. Well, how do we quickly guess at depreciation value of each property based on the form? Well, this is something I'm going to give you as a real easy rule of thumb. If I take the depreciation number, which in this case is right here, and I multiply that by 28, that gives me an idea of what the value of the property was when you bought it for depreciation purposes. So I may not know how much you paid for the property, but it's one of those things that I can do at a glance and I can have a pretty good quick guess. How does that compare with current value? Sometimes we have to look if you've been owning and depreciating this property for the last 10 or 15 years, but it's a very quick way to look without even having to ask an accountant or anyone, can you tell me what I paid for the property? Because most of you don't have the faintest idea. You remember a number, but you don't remember what actually happened at the closing table that would have gone over and above what the price of the property was. Now, when we go back and how much of a percentage of rent did management charge on these examples? Well, can you tell if they take a month's rent to screen for new tenants? How do you do that? You can't always do that because that's just going to be wrapped up in the amount of rent that is collected. And if they charge any management fees, if they charge a management fee, that's an additional cost to the property that we have to factor in before it ever makes money, on top of the things that we talked about before, repairs, maintenance, taxes, insurance, HOA fees, any of those type of things. Well, how does a vacancy or an empty showing turn up on your taxes? Well, you see, it doesn't always show up, but what shows up, there's a place that we can look and see how many days it was rented and how many days it was vacant, as long as you kept good track of that. For some individuals, they don't keep as good a track and their guesses. What we're going to see, though, is a change in what the income was. If I had a property that was rented 12 months of the year for $1,000 a month, I could glance at the tax return, and if it said $12,000, I could pretty much guess that it was rented all 12 months of the year. If my $1,000 a month property only had $6,000 of income, well, I have one of two things happening. Either the property is occupied, but someone is not paying the rent and I'm trying to evict them because they're 6 months behind, or I did not have the property rentable for 6 months of the year. Maybe I had to do a lot of repairs between tenants, or I couldn't find a renter. So we can look at some things that give us an idea of vacancy and how much it's actually pulling. Now, for some of you, you may do 1-year leases. If I do a 1-year lease and my renters turn over every year, rarely am I going to have that property rented every month, because when one tenant vacates, I may need to go in and do some repairs, maintenance, cleanup, or another person is not available. There's got to be some screening. Sometimes you do not want to show the property while you have renters in it. That's a matter of preference and what you have in your lease. But it's not uncommon when you switch renters to lose 1 to 2 months of rent. Now, if you have a management company and they take 1 month's rent as part of the screening process, now you could lose 2 to 3 months of rent in addition to whatever management fees and the vacancy. Are you understanding why I am so adamant about we have to know these properties are going to make you a profit, because they can drain you very, very quickly when things are not working out. You need that little bit of padding. And then what happens if you have losses, which means you've put money in the property, but you can't deduct them on your income tax returns? Well, nothing happens. You just shelled out the money, and hopefully someday the rental property will make profits that you can use those what are called carryover losses to shelter some of those profits, but it will not help you today. It's only going to help you tomorrow when you sell the property or when it's in a profitable status. Now, for some of you, you may not realize that you have carryover losses for many, many years and had no idea. And you're not going to be able to recapture or reap any benefit from those unless you sell the property. This is unique to each property that you have. Now, when we talk about properties, let's think about if you just did a snapshot. I'm going to ask you, think to yourself, which ones of these properties would you keep, if any, and why? Because every property is a little bit differently. And when you look at a property, it's going to cost you money to hang on to it. It's going to cost you money to let go. But we are looking at the highest profitability for your investment that we can possibly get, and rentals are no different. If you wanted to buy a losing investment, those are available to you, but they may not require the responsibilities of being a landlord and screening tenants and answering phones. Most people want a property that is compensating them for the risks they're taking in property ownership, plus all the effort that is required to maintain the property and handle all the taxes and the bookkeeping that goes along with it. So we're going to go back to our sample properties. We got 6 properties here. Looking at this, which properties would you keep? Which ones would you let go of? Would you keep them all? Would you refuse to sell any? Well, what do you think? I mean, I can go down here and I can say, well, this one's making money, and well, that one made money. Well, geez, this didn't make a whole lot of money, but well, maybe I'm only going to have those repairs for 1 year. So maybe it'll be better next year. And I could look at these other properties here and go, well, it's not rented for much. It's making a little bit. And oh, wow. Well, this one cost me dearly, but was it because it's not rented all of the year? I can't evict someone. In my experience, this would be very helpful, but I don't think it would be able to give us the answer of what property should probably be sold and what should be retained. I'm going to reiterate, I would go back the last 3 to 5 years to see what historically has been normal for this property, if there is such a thing as normal. And along with that, we're going to have the discussion of what do you think is going to have to happen on this property in the next 3 to 5 years, what it's going to cost. And unless we can look at those two components, it will be very difficult to just look at 1 year of taxes and determine whether a property should be retained, whether a property should be sold. And I mentioned that carryover losses, that's going to come into the equation. Whether you have capital gains or not, that's going to come in the equation. As this is being filmed, your capital gains rates, I would tell you, don't worry about it. They are a lower rate than what your income taxes are. So do not be afraid at this point to pay taxes on a profit or to pay taxes to get out of a situation if it's going to be better for you on the long term. So we're going to do a little bit on raising the rent exercises. So if we're looking at raising the rent, we're one slide ahead. If we're going back on raising the rent here, can you do it? You now have a number which is approximately 1% of the value. What if and again, I'm using a real easy example. I have a $200,000 house, so I need to be making at least $2,000 a month, but I'm only charging $1,500. I may be able to raise the rent $500 in one fell swoop. That would be pretty tough for most people to handle, because you're talking about, at this point, what, almost a little over 30%. I may have to do it gradually. The property may not support $2,000 a month in the area, and that may be the catalyst for why the property has to go, because it doesn't have the potential. And this is something unique to each property. So when we talk about selling the property, we always are going to have a gross sales price, whatever that is. And I'm going to have to take off whatever your selling fees are. Do you have a mortgage payoff? And what are the net proceeds that you might have? And then I want you to realize that you may leave the closing table and have cash in your hand that is one number. Depending on the length of time that you have owned the property, and you have been claiming depreciation over all of those years that we have to bring back or recapture, you may actually leave the closing table with $10,000 in cash. But what if you had $50,000 in gains? Every time you look at selling a property, these are things that we have to factor in so that you do not get an ugly surprise, or when it comes time to file taxes, you go, wait, I had no idea that I needed to set some money aside out of the profits that I made in order to pay the tax bill, because this is one direction that you can go at that point. Now, when I mentioned that every situation will be different, you can do a tax projection. The other thing most people don't realize is every time that you put an entry on the tax return, it's very similar to a pile of dominoes. You know how you played with those as a child? And with the dominoes, you may have lined them up, and sometimes they'd go in a curly Q or a straight line, or they'd split and go in a Y shape, or whatever you did. Every time you put an entry on the tax return, it recalculates, and it can trigger something else, whether that is triggering something that is to your benefit or triggering something that is to your detriment tax-wise. All of these things are factored into what your final tax bill would be. For some clients, they may not want to sell a house in October or November in a particular tax year, because it would be detrimental. If they held off until January 2nd of the following year for a closing, then it would be much more beneficial. You're only going to know that when you work with a professional at that point. You may also have a tax loss that would save you taxes. That's the going back over the last 3 to 5 years to determine what is normal for the property that you have. Now, are you starting to be able to grasp what a black hole on a rental property can be, but you weren't necessarily thinking of it that way? So my observations: a black hole is a dwelling or other rentable building that you throw your money into, taken from other cash resources that you are never going to see again. There is never enough money to throw into a black hole, because you cannot possibly fill up a black hole. I don't care how much you put in cash, it does not happen. Now, for those of you, if you were looking at, well, how do I get a few symptoms of what a black hole might look like? Well, do you cringe every time the phone rings about that property because you've had nothing but what we'll call bad luck or problems? Do you get angry when it is mentioned in conversation? Sometimes that can be between partners, or it can be between a couple about, I hate that property. I told you, you were there last weekend. Your tax returns never show a profit, with or without depreciation factored in. And you have carryover losses that you have not been able to deduct. And in your dreams, you dream someone would come offer you money to take that property off of your hands and release you from the responsibility. I'm going to give you just a different idea. If you were a landlord, and we're going to talk about different options. So some of you don't get all bristly when I start with an annuity, because we're going to talk about other things. It was just a place to start. If you have a rental property, unless you have a manager who is dealing with it all, and they still call you when you're making decisions about repairs and those type of things, you have the responsibility of maintaining the property, handling rental calls, handling your agent's calls, whatever the case may be. And there is labor involved there throughout the years that can be significant, drain on your time, on your finances, and on your emotions. Now, on the flip side of this, if we look at, well, what else could I do? What if I took the money from a sale and hypothetically it's $100,000 because it's just a number after I'd pay taxes? Well, there are different kinds of annuities. And for some individuals, they will say, you know what? I never want my phone to ring again. All I want to do is open my bank statement, and I want to look on the statement, and I want to see a positive number deposited in my checking account that I had to do absolutely nothing for. You could go and talking with annuities are sold by insurance companies. You have to have a licensed agent. They've got to be in your jurisdiction. You could have a fixed annuity. That's something that's going to pay a fixed rate of interest over the life of the contract. You could have an indexed annuity, which is tied to some gains in the stock market, but you don't actually participate in it. Then we can have a variable annuity. That's where you have some options that you can do more into stocks and bonds. We're not going to go into them, but the advantage for some individuals with an annuity is that they can just open their bank statement and they have a sum of money deposited in their account, and they do not take another rental call. This may be attractive to you. It may not be attractive to you. Now, you would get quotes from more than one carrier. My suggestion is usually an independent agent, independent rep, because they can offer, products from more than one company. But you need to know what you're purchasing, whether you are locking it in for a lifetime, a period of time. So it is an option if you decide you don't want to be a landlord anymore. Now, some other things to consider go on: how old are you? How long do you want the income? A lot of different things, but an annuity could be an option for you. Well, what if you sell out and you buy a different property? Now, some of you are going to be in the audience and go, well, I can do a 1031 exchange and I won't have to pay taxes on it. I agree. You could sell out and buy another property and pay the taxes now. And in a lot of cases, I think you're better off to do that. It depends on what your tax bracket is. Did I mention this is unique to you? When I say that you can pay the taxes on it, what if you're in a very low 10 or 12% capital gains rate? Well, that may be a very good time to sell it if you're looking at holding on to it. And later, well, I'll just defer the taxes with the 1031 exchange. Well, if tax rates are going up or your income dynamics are going to change to where your tax bracket may go up, deferring it may not be in your best interest. And you have to identify a property within strict guidelines. And there are things that have to happen to make that a viable transaction. So you have another option there, but then you would be continuing with the responsibilities of a landlord, and you may really like that. That's entirely up to you. Now, I'm telling you when I'm working with rental properties that I am looking for a deal. So I'd like you to remember this. So on a deal, we want a discount, we want earning potential, appreciation, leverage. It has to have some of those. Now, what is a discount? Well, a discount is when you pay less so you can profit more. If any of you have ever waited until something was on sale, you were buying it at a discount with the idea that you have gained something, or you haven't spent it. What about earning potential? Are you going to get paid to own this property? We're going to go back to the difference between a cash cow and what is a black hole. I'm looking for appreciation, a future payday. Early in the presentation, we talked about how appreciation does not necessarily mean that you make money on a property if the appreciation rate is the same or lower than what inflation has been, because your buying power will not be any better. And if your appreciation average is less than inflation, then you've actually lost buying power in that scenario. And the last one is leverage. For some of you, the deal will work if you can use other people's money, which means a mortgage, and you can still make a profit on the property. There are those of you who will leverage your own resources and you will pay cash for it, which goes right back to what type of a return do you need to have on your money, whether you're using annuities, you're using mutual funds, you're using CDs, you're buying individual stocks, Bitcoin, whatever it is that you like or that you think you're good at. Where is your leverage on those dollars? And is the rental property going to give you the leverage for the return that you're looking for? Not the answer for anyone, but again, I mentioned you could buy a different property with a 1031 exchange. You need to understand this process, I believe, before you ever put your property up for sale, and have a plan of action in order to execute, because you are limited on the number of days that you can actually make this work. You need to have a plan B. What if the property sells, you cannot find a property to turn the money into? Then you're going to pay the tax bill and you're going to move on. So plan A, plan B. Not the answer for everyone, but you could invest in stocks and mutual funds. You will not have a guaranteed rate of return, but a variable rate of return may be fine for you. And with that, you may be looking at it, and capital gains that are spit off by mutual funds are at a lower tax bracket than what your earned income or interest would be. So is this an option? It depends upon your risk level, and it also depends on what your preferences are. Now, with stocks and bonds or mutual funds, you may or may not increase the value of your original deposit, because those are going to fluctuate. Taxes are going to come into play, whether you're paying some of those as you go along, or if you sell it later at some point. Who's going to manage the investments? You know, this is not a crock pot. You can't just throw it in there, set it and forget it, and go take the lid off in a while and hope everything worked out. What does it cost to manage the investments, and how frequently? You need to be looking at these investments on a regular basis. And a lot of people will set it aside and they don't even open the statements, which is absolutely amazing to me. But I'm telling you, a lot of people just don't bother because, oh, well, I'm not planning to do anything with this for 5 or 10 years. 5 or 10 years may be way too long to set in the same investment if that investment has changed and it no longer meets your needs. You should have some type of an advisor who can assist you on those things and to monitor. And it doesn't matter whether you are working with, I'll throw a couple of names out. Vanguard is one that you can choose and do a lot on your own. There are still tools online, people you can call. There are things that are available that are built into your investment. So don't hesitate to use those. And one of the other things that we can go back and do is I'm going to go ahead and I'm going to stop the recording, but so that I can answer some of the questions live. Now, what I will tell you is that if you would look over in the chat, for those of you who are viewing this live, you are welcome to go on to Facebook. I would encourage anyone who's watching, go to my Facebook page. And if you go up underneath more, and then if you click on under events, you are going to be able to see what other classes and things that I have got coming up. And I try to book those out quite a ways in advance, so you have an opportunity to register and to put them on the calendar. And then the other thing that would be available down in the show notes that I will put on a link, that if you want to schedule an appointment to visit with me, you are certainly welcome to do that. So, and I am Amy Rose Herrick, and I am America's Profit Building Specialist. Thank you for spending some time.